The close of 2024 is going to be an interesting time in housing. Everyone's been waiting for the Fed to soften rates. They finally did. As everyone knows, there's a loose correlation between what the Fed does in terms of their short-term target rates and what manifests into longer-term debt instruments like a 30-year fixed rate mortgage. We're going into the winter months. We're going into a period of time when the market's generally cooler on the demand side. Only time will tell how much demand stimulation there's going to be, and that's probably not going to happen for, at least in my opinion, another 6 months to a year. We're talking about getting mortgage rates down into the 5 range before you start seeing homeowners that coming off the sidelines and be okay with sacrificing their once low-cost mortgage.
Welcome back to Nevada Realtors Today, your place for timely updates on the news and trends that matter to realtors in the Silver State. Now let's join your Nevada Realtors President, Brandon Roberts, and Nevada Realtors CEO, Tiffany Banks, for today's episode of Nevada Realtors Today.
We are joined today by the incredible Dr. Sean McCoy, who is the director of the Lead Institute for Real Estate and associate professor of real estate and economics at UNLV's Lee Business School. At Lead, he is responsible for leading the Lead Center's mission to train, mentor, and place students in the commercial real estate profession. As a researcher, he specializes in the fields of real estate and housing economics, applied econometrics, and geographic information systems, publishing extensively in the world's highest ranked journals in his fields. We're so incredibly lucky to have you today. And so, Sean, what do you think are some of the current trends in the real estate market that you find particularly interesting or concerning? Let's go with interesting first, and then we'll go to concerning next.
Hands down, in my opinion, the most interesting patterns in the data happening right now are inverted market structures for multifamily housing. Things are changing right now, but what happened in 2022 and 2023 was quite remarkable, but not positive. Taking us back, it was really the back end of 2022 and the first quarter of 2023 when we started seeing the headlines in local newspapers: rents are falling, rents are plummeting. And my colleagues here at Lead Center for Real Estate and I were looking at these, and on one margin, we recognized, okay, the data's right. Rents on average are indeed falling. But when we're talking with local officials and many renters and many homeowners, you're getting very different stories, right? We're seeing a lot of asymmetric response from people in the field, actual home buyers and renters, that, hey, they're feeling the pinch and they're seeing rents go up. And this created a statistical conundrum of sorts. We wanted to know what on earth is going on, because something's clearly going on beneath the surface of the market that we're not picking up in the data. And the first thing we did is, for 2022, 2023, and early parts of 2021, we collected data at the building level for every 50 plus unit multifamily property in Southern Nevada. And we tracked effective rent and asking rent per unit for all these buildings over the course of, again, 3 or 4 years. And then one thing stood out. One thing really stood out. In the first quarter of 2023, we, at the market level, saw multifamily rents fall very modestly, $10, $20 a month in terms of asking rent. At the building level, though, we found that the market began to bifurcate or split apart. 48% of properties in Southern Nevada showed rent decreases, and 52% of properties showed rent increases. The average just so happened to average out to be about constant rent, but there was certainly something going on. And so to find out what was going on, we had to map all these buildings. And so much like a meteorologist would take a bunch of weather stations and record the temperature at each station and then create a high resolution heat map, where's rent popping in a city, we use those same methods to visualize what's happening in the housing market. And that gives us a very clear sense: where are rents going up, where are rents going down, and what might be going on behind the trend. And what we found was it was precisely in neighborhoods that were once considered low-priced rental neighborhoods, it was those neighborhoods where we saw rents going up. In contrast, it was neighborhoods where we saw rents priced at higher ends of that rental distribution softening. And a lot of things were going on at this time. On the supply side, a lot of the new multifamily inventory that was coming online tended to favor the higher end of that rental ladder. We're talking Class A luxury units, oftentimes in typically higher income, higher earning neighborhoods. And so you had supply that was partly explaining these rent increases, but it was more difficult to explain the rent increases in the low income neighborhoods. One of the common stories, narratives about what likely went on is in 2022, 2023, you had this trifecta of everything imaginable in the economy hitting home buyers and renters all at once. High mortgage interest rates, high cost of living, inflation at all-time highs, immediate post-COVID consumer savings being depleted to low levels. And you can't really overnight say, hey, I want to earn more income. But if you want to increase residual income, you can certainly move, if you're a renter, rent something less expensive and try to improve your residual income to improve your quality of life. And so this idea of moving down the rental ladder is what we believe was one of the factors driving this inverted structure in the marketplace that gave rise to rising rents in low income neighborhoods and falling rents in high income neighborhoods. Once again, in a period where market rents were falling. And this goes back to this idea of spatial analysis it also goes back to thinking about forecasting. Because no neighborhood experienced constant rent, but the market did. Which means that even if we could forecast the market correctly, which we can't, but even if you could, it means that the forecast would have no bearing on anyone in the marketplace. Whether you're an investor thinking about setting rents at a building, or you're a potential home buyer or a potential renter, you care about what's going on in a neighborhood and in reality, what's going on at a specific property.
What's interesting about that is, and I know we've chatted about, we traveled all over the country just trying to get, like a handle on cities like such as St. Paul and Minneapolis. And so many of these landlords in low income neighborhoods, mom and pop landlords that we spoke with, they were saying that they, in those years, were almost forced in a way to raise rents because theirs were so below market. So you were almost seeing like this market shift in that, like, they're like our tenants, and just, they were saying they were paying something like several $100s, like that low of rents that were so low for so long that they were like, just a little jump. And even if it was $60, even if it was $100, at that level, it seemed like a big jump. Whereas if there was more inventory than you had in the night, like you're saying, in the newer developments, prices seem to come down. And so it's actually interesting, maybe this wasn't just taking place in Southern Nevada, but maybe across the country.
Yeah, I think it most certainly was. And if we look through the media, we'll see articles from spanning the Washington Post, New York Times, everything across much of the United States. We saw very similar patterns. It seemed to hit Nevada more so. And the first thing about rents and prices is landlords don't really get to set rent, right? I mean, when I teach my principles of economics students about who has bargaining power in any type of business transaction, take the argument to the extreme. If things break down, then the logic is wrong. So with multifamily housing, if landlords really could set rents, well, then they should be able to set rents to $20,000 a month, but no one's going to buy them. It's really all about supply and demand coming together that determines what people can ask for a rent and effectively get a tenant into a particular building.
Absolutely.
And so with that framework sort of established, it then can give us clues where to look. And part of the Southern Nevada story has in my opinion, a lot to do with what's happening in the market for vacant land. So, as we all know, uh, land is scarce. Developable land is scarce in Nevada and certainly scarce in Southern Nevada. And one of the consequences of that is, given the restrictions that are imposed with, for example, typically for federally owned land to be transferred through an auction process to a private buyer, these land parcels need to be situated in the Southern Nevada's disposal boundary. Land supply constraints change everything about housing economics. When these land supply constraints bind quickly, like they're right now with basically every analyst that works in this space forecasting 8 to 12 years of remaining vacant developable land for Southern Nevada, what you get is increases in the cost of land, significant increases. Land prices, we all know, are themselves at historically high levels. Then throw in construction costs. Construction costs, even now, are still 40% higher than they were pre-pandemic. So what goes on the supply side then? Let's go back to this rising rent in low-income area and falling rent in high-income neighborhood story. All this does not bode well for unwinding these market dynamics, because land prices tend to rise pretty uniformly throughout a city. Unlike when you look at a market and how, when you spatialize housing data, you'll see lots of variation in both rents and home prices, much less so in the market for land. When land constraints bind, especially when we get down to the last few drops of land available, you see prevailing land prices accelerate quite quickly. And all this means is that rents prevailing in an existing neighborhood might not be enough to make investment pencil in those particular neighborhoods. So supply may tend to be biased in favor of neighborhoods that command higher rents. And this is not a fault of developers or investors or anyone in between. It's really just a pure artifact of structural challenges in a city that can and do need to be addressed through various policy instruments.
Absolutely. And I think when you and I chatted before, we did discuss the uniqueness in Nevada, that we have 80 something percent of our land is federal land. And so we're actually faced with a more difficult problem than most other states, right? Like, you were actually really helping me understand that point alone was
Yes.
actually like a major impact. So if we can
Yes.
actually open up federal lands, create more opportunity for develop, not just subsidized housing, but all housing, private housing, attainable housing, all of those things, what would our economy look like? What would Nevada look like?
Exactly. And the nuance with that connection between land inventory and just the overall quality of life, and importantly, what it means for the efficacy of public policy, is very rich and very, very fascinating. So, starting with some basics, why the land situation can't be ignored. Take something like rent control, for example. Rent control, and we could talk about why I particularly think this is a bad idea later on in this talk. But let's just start with the basic economics of what a rent control policy might do. But again, keeping in mind that rent control can and likely will end up being a land story. So when we stabilize rents or put policies in that freeze rents, or in broad strokes, thinking about policies that tend to cap rent, the first thing that happens is that the option value of developing, or even the option value potentially investing, falls. We're looking at a building and we look at rent control, putting caps on net operating income. One way or the other, this is reducing the value of development, value of investment. So a couple things then tend to happen. If I was a developer and looking at a vacant parcel of land, and then realized that if I were to buy this parcel, moving into the next year, there'd be a policy in place that would restrict where and how I could set my rent. I might look at that parcel, and that marginal developer might say, you know what, I might not be able to make that project pencil given the restrictions on what's happening with rent setting.
Mhm.
So the very next step in terms of the market economy, demand for these parcels may tend to fall.
Hmm. Mhm.
And when you have a lot of land, think lots of land sellers, lots of potential
Right.
land buyers. When you have lots of land available, when demand for land falls, then prices may tend to fall as well. And that might offset some of that lost potential gross income that's being imposed by the rent control policy.
Mhm.
Not really going to see that happen in Southern Nevada, right? Land prices are sticky and they're going to be sticky for a long time. And so when you do things that destabilize the income structure, the income flow going to a property in any way, um, there's not that potentially offsetting effect on the land market that you might see if you had hundreds of thousands of acres available. You would expect in a market like that, land prices to be more flexible. And the punchline is, in terms of the supply side distortion
Mhm.
of housing policy that targets what we call the demand side, think rent control, think inclusionary zoning,
Mhm.
the unintended consequences of those are predicted to be much larger when we're in markets that have very, very limited supply of land.
Mm, mhm. So fascinating. And, like some of the same, traveling across the country and having these conversations, some of these developers or actually city council people, they were saying money moves. So development, a developer might want to move, for instance, to Southern Nevada. They have a project. You all of a sudden have these policies that are overly restrictive or burdensome. Like we're saying, things just don't pencil out. They're going to move somewhere else. They're not going to really support the economy, like money's not going to go to the tax base. Everything they're pouring into that community, they're just going to move somewhere else where they have less restrictions. And so when you start thinking about these unintended consequences, and to your point of like, then we also have all of this land that we can't even get our hands on. Like, what does that do for us? And it's really scary, actually. I think that, it's really hard to get the message out and get educated about these issues, but I think the more you kind of dig in and actually understand this isn't just a simple statement, right? Or it isn't just making sure that rents are lower. It's actually like looking at economics as a whole
That's right.
and the impact that you have over wide ranging industries and people. And yeah, it's
When I think about rent control, if I were to come on this podcast and say I have an idea for a policy, and this
Mhm,
policy is going to try and stimulate demand but
mhm,
limit supply, you'd be like, "What are you talking about?
mhm.
Stimulate demand and limit supply? What problem are we solving here?"
Right.
Okay, well, this is what rent control does.
Mhm,
Right? It again, anything that reduces the option value of development is one way or the other viewed as a tax, and when you tax things, you get less of it.
mhm. Right.
And so, you know, the thing is that in theory, right, rent control policy. I mean, if you had a law that said rents can never be more than $1,000 a month, well, guess what rent you're going to see in a city?
Mhm,
$1,000 a month.
mhm,
But the catch is what happens on the supply side is you're going to have backing out of the market, backing out of inventory. And while those rents might be low, the quantity of available housing becomes low. When
mhm,
you tackle housing policy through the supply side, think
mhm.
about whether it be a tax credit to spur development, whether that might be the release of federal land
Yes.
to
Mhm,
soften land prices and get more development. All this is doing is shifting that supply curve to the right,
mhm,
increasing the supply of rentable and for sale housing, which is doing two things that we both want in the right direction:
mhm.
lower rents, lower
Yep.
prices, and more housing to go around.
Absolutely. And I think you mentioned quantity, quality also goes down. And I think that that's what we see in a lot of these cities that have been negatively impacted is the quality because the landlords are saying, I can't afford, like one of these, bless her heart, she was this amazing woman that says she snakes all of her own toilets and snake, like her tenants are like, they call me and I'm over there snaking everything myself because I can't afford to hire someone else to pay for that or I'm, like
That's right.
losing money at a huge amount every single month.
That's right. And in a competitive market, that behavior is
Mm-hmm.
oftentimes punished very quickly.
Mm-hmm.
In a competitive market where we don't meddle with
Yeah.
prices, if I'm renting a unit and my toilet's not getting fixed, I'm going
Mm-hmm.
to complain, potentially move. And believe you me, that landlord is going to come in and take care of their property. They also want to take care of that property because they want to protect the cash flow that they have in place from that competitive market price.
Mm-hmm.
If I was living in a city that had market rate rent of $5,000 a month and a policy said the most you're ever going to pay is $1,000, people are going to want these units. They're not going to want to leave. And regardless of what happens in terms of what the landlord does, well, they're not going to immediately bail because the option of what happens next can be far worse. What
Mm-hmm.
that does is it sort of cripples the market economy at its feet and sort of creates an environment where a landlord in that case might forego capital investment in their property, knowing that, hey,
Mm-hmm.
it might not have even though it might bode well for renter demand. Rents are what they are; they're
Right.
stabilized, so we're not going to
Right.
recapture it on that end, and we're also not going to lose it on the front end because the tenants are very unlikely to leave in the first place. And
Mm-hmm.
so this notion of falling housing quality is a very, very, very real concern.
Absolutely. And Brandon, think about, the property managers that you work with and the property managers working with the owners, they don't want to raise rent each year, right? But it's almost like rent stabilization and rent control forces you to then raise rent each year if there's a cap on that so that you're able to kind of keep up with the market in whatever way you think is best.
Right. And, Sean, this is fascinating to me because as a practitioner, I'm in the market of property management. And like she said, I work with a lot, even as on the state level as a president, we talk to a lot of them and just seeing how things work. And I'm curious, back when you were talking about the statistics of some of the lower neighborhoods had higher increases and the richer neighborhoods, so to speak, had lesser. Was that done just mostly off of multi-unit housing or complexes, or was that taking into account single-family residences as well?
Good question. It does not take into account what's happening on single family rentals. Data is much more difficult to come by on what's going on with those lease structures
Hmm.
for single family. So we don't know what was going on with single family, and so the dynamics there could be quite interesting. They could be different. I tend part of me tends to doubt that. I think that in broad strokes, um, you know, one of my favorite statistics is just looking at the average size of housing units that transact.
Hmm.
It's such a great indicator to see what's going on with the composition of a market. And when 2022 hit, again, this is the world where we not only had pre-existing high asset prices, we now had high inflation rates, high mortgage rates. We had that was a trifecta I was speaking about. All three things colliding at once. And the fourth one was really the fact that we just escaped a world of historically low rates. So that partly
Mhm.
explained, largely explained why asset values were so elevated moving into 2022. The average size of housing was falling precipitously amongst houses that were transacting on the single family side. It's not by a lot, but by about 70 square feet per
What does
year.
that mean to you?
It means that people that work buying and closing deals were
Mhm.
tending to be buying smaller houses.
Mhm.
And this is one way of combating affordability is if we
Mm.
can't get a break in the purchase price of a home, we might just go and buy lower priced homes, which tend to be
Mhm.
smaller homes. And this can again create an inverted demand structure like we saw with multifamily, whereby rents could be very rigid for once smaller homes, once low priced units, and tend to soften at higher ends of that housing distribution. And it's really problematic for the health of the economy for so many reasons. But at its core, the lower a homeowner or a renter falls within the income distribution, the fewer options they have for housing. If someone's at the top decile of household income. Basically anything in the entire market, with the exception of a few properties, generally be affordable. As you go to the bottom decile, only properties at or below their affordability threshold are going to be fair game to purchase. And so when you see the bottom end of the housing market expand more quickly than the top end, people at the bottom are going to feel that compression hit extremely quick. And the term we've been using is the crushing cost of housing, because it does, and it can crush both renters and homeowners very, very quickly. And but again, getting back to the basics of supply and demand is, there's a lot of moving parts here. There is this, the supply side of the story matters, but monitoring what's happening with debt, what the Fed is doing with interest rates, matters a whole lot. And really, when we're talking about the housing cost problem in the US, we really weren't talking about 2016, 2017, 2018, and really not even 2019. It was really what happened in that immediate wake of COVID, 2020, 2021, 2022. Massive amounts of money being pumped into the veins of United States of America, making money cheap, inflating purchasing power, and driving asset prices across the board, across all asset classes, to all-time highs. And we have to not forget that's part of the story here, because what we learn from that is, things about, supply, for example. We know supply is a problem in Southern Nevada. Supply is a problem in many parts of the US. But has this story about vacant land, did that change structurally over the past 2 to 3 years? The answer is no. These issues have been here for a while. So I find it hard to believe that rampant uptick we saw in renter costs and owner costs had a lot to do with what was happening with expansionary open market operations by the Fed. At the same time, though, is when land is lush and available, when the cost of debt falls, the option value of development also falls, and that supply can respond very, very, very quickly. That didn't happen like we wanted it to in the wake of COVID, because while money was cheap, we didn't have the land. But on top of that, construction costs skyrocketed. And there's also supply chain bottlenecks hitting basically nearly every part of the supply chain in the US. And so what happened is you have all the downside of rising housing costs through stimulating purchasing power, and you have none of the upsides that tend to happen with capital investment in the marketplace, which is really kind of the narrative of what happened post-COVID and why we got to where we're at.
So you don't think that people wanted to move into smaller homes because they realized during COVID they loved being together, really close quarters all of the time. So they're like, I don't want to be separated from my family anymore. I want to be able to just hear everything and connect more. That's
No,
you didn't think about that one?
they homeowners were buying smaller houses because they were cheaper.
Yeah.
And right, and in many cases, this idea of co-household formation, something that's very difficult to study, but I suspect a lot of it's happening in the market right now.
My mom moved in with us.
Yep, and it tends to happen in periods of time when wages don't tend to keep up with rising housing costs. People will co-occupy homes to help. Again, part of it's about preference. Part of it might be, we want to live with our family and do this, but another part of our demographic might not have any other option, and cohabitating units may be the only option in terms of a pathway to home ownership. And the challenge with that is it can distort what we learn from the data. When we look at the overall debt to income ratio reported through the Home Mortgage Disclosure Act, we're getting a sort of a grand overall statistic of what's happening with the full applicant, whether that be a single person applying by themselves or a group of households. It all gets lumped together, and the mortgage metrics might look healthy, but behind the surface, you may see the individual families that are pairing up not able to, talking about how expensive housing got. This one, I think, is fascinating for all the wrong reasons. We wanted to consolidate what was happening with mortgage interest rates and the cost of owner-occupied housing into one metric. And this was quite relevant because between, for example, 2016 and 2024, mortgage rates basically doubled, going from about 3.65% up in upwards of 7%. Price per square foot of housing went from about $130 a square foot, upwards of $250 a square foot. And so you had costs creeping up. We didn't even bring in insurance costs and all the other stuff, which, by the way, is non-trivial. Not even factoring that into the equation. But how do we connect the both into one statistic that can tell us what's happening with purchasing power? And the answer is actually quite obvious. I said, look, let's just look at the median homeowner or any particular homeowner given their income and ask, at current mortgage interest rates, how, and given the prevailing price per square foot of housing, how much house in terms of square feet could a homeowner finance and purchase? We do this exercise for 2016, and we also repeat the exercise for 2024. The amount of house that the median homeowner could finance in terms of square feet fell by 2,134 square feet, which is basically the size of the average home, meaning that anyone at or below the median was effectively priced out of nearly everything in the marketplace. In terms of purchasing power, it manifests about $140,000 decrease in purchasing power over a time period where home prices went up by several hundred thousands of dollars. Yeah.
Fascinating. What motivates you personally to stay engaged in research and education in this field? Because you're so passionate about it, which I just love. I admire that.
At its core, when participants of a market, regardless of where we're at in the market, being in a university, being boots on the ground in the field, being a consumer of goods, being an individual homeowner managing their finances, whether, and this principle that I'm going to talk about applies to every aspect of human decision making and human psychology. When people have good expectations rooted on facts and good information, even if the outlook looks bad, humans are really, really good at adapting to adverse situations. And when we surprise people, we surprise our kids, or we surprise a homeowner with a new cost, or we're taking out a loan, there's a surprise hidden fee. Not only do we have a difficult time managing it, we tend to make poor decisions, feel bad about the transaction, and the overall health of the economy can worsen. When we have good information on the housing market and the economy, how public policy works, what's going on in the marketplace, and that's really, really important. Before I got into this academic world, I had a background in construction. I wore a tool belt for 10 years working in Southern Nevada. And so when I got into an academic seat, it was a culture shock for me because we're looking at these big trends and I'm thinking about like this house right there it is something's different about it. And in my role, I have renters and homeowners. They call all the time to our office and just sharing stories about what they're going through. And more times than not, those that call me are telling me about a story they're going through that is inconsistent with what we're talking about in terms of overall market trends.
Yes.
And the difficult with the conversation is that the market trends aren't wrong. It's not, I've looked at all the data. We might take a fine tooth comb and nitpick a detail, but more or less we have really good data in Southern Nevada, what's going on with housing. But if you talk to anyone that works in real estate, location, property, what's going on at a specific house matters more. The phrase that I like to use is a market trend can tell the story of the market, but cannot tell the story of an individual homeowner. And when we think about data in that way, one thing that really gets me motivated about doing the kinds of work that we do, which is all about studying what's going on down to the street level, down to the property level. When we talked about mortgage default rates are at a historically low level. They're at the lowest level they've ever been. They are upticking, but when we're going from, a thousandth of a percent to 2,000ths of a percent, it's an increase, but is it really economically meaningful? Depends on who you ask. In one of our recent reports, we did a process called the process geocoding. We took every notice of default filed in the Clark County Recorder's Office, looked at the address, and then ran it through the computer to get the latitude and longitude coordinate that identified where that notice of default happened in the marketplace. It allowed us to plot the actual locations of homeowners defaulting on their mortgage. And one thing stood out. There wasn't a lot of default, but there were about 3 neighborhoods that saw a lot of default. In fact, more than 50% of all NODs that were happening over the course of the past year were accounted for from about 3 small neighborhoods in Southern Nevada. And the punchline being, again, is going back to that idea that market trends tell the story of the market, but not the homeowner. Yeah, maybe 99% of the market is not worried about mortgage default on the horizon. But when you go and talk to specific neighbors, specific neighborhoods, they may be feeling the pinch.
So what does that mean to you when it's just pockets of several neighborhoods that one goes into default and then then the house next to it then like is worth less? Like, do you think it's just like this ripple effect or?
So there's a lot of research that thinks about this idea of contagion in the housing market. There was some research. I don't know if I buy it, frankly. When we think about mortgage default, we're thinking about structural issues with the home buying process and income situation of a home. So typically what that would tell me is that there was some characteristic that we don't know what it is that those housing units in that specific area had in common that might have led to that default cluster. For example, suppose that we had a new home development that offered a teaser rate on the interest rate that ramped up a couple percentage points 6 months later. That might be something specific to a neighborhood that might catch a home buyer off.
Right.
Right. That might then
They can afford to get in, but they can't afford to sustain that.
Exactly. And so when you see clusters like that happening, it's usually, at least with mortgage default, something more structural about the type of housing, the size of housing. There could be clusters of people in certain occupations that tend to cluster together. This is all anecdotal. I haven't explicitly studied that.
Brandon shaking his head in agreement with certain things.
Yeah. No, I believe they probably bought it about the same time or bought it about the same way. And neighborhoods tend to cycle. And so I would guess, without having the data, that it was probably something like you just said, how they purchased it. Do you think, okay, so the data is important, obviously, because you get excited about it and you guys spend a lot of time putting it all together. Do you think it tells a better story about what's happened, or can it be something that can kind of tell the story of what's going to happen in the future?
I am extremely cautious about using historical trends to predict the future of housing. I really am. There are some exceptions. When in real estate economics, there are questions that we looked at are retrospective, but that can have forward-looking implications. For example, we might look at shifts in school zone boundaries, to get a sense of how the market capitalizes different school quality metrics, to get a sense of how that manifests in terms of a price outcome. That number may give us a good indication of how we might expect home prices to change if we change the quality of a particular school at some point in the future. This is an area where the data can give us a very decent prediction as to what might happen if we add some amenity or change something in a neighborhood, if we add a neighborhood park. Not always. The literature, for example, trying to document the impact of adding a pool to a property on the value of a home is all over the place. There's really no really good consensus about what that value add of a pool is, with much of the literature, if anything, showing that the return isn't recaptured in the price of a home. And a lot of this has to do with something we call endogenous selection on the part of home buyers. For example, there was a study released by a very popular real estate periodical, and the headline of the paper was, "What's the value of painting your door black?" And the answer was $6,000. And I thought, well, how did they get that number?
Yeah.
And so, first thing I did is I go find the study. And what I learned is that what they did is they surveyed like 20 people and just asked them, how much would you be willing to pay if you had your door painted black? And that was how they got the number. So that was a structural issue to begin with. But there's an even deeper issue. A homeowner that chooses, like, I painted my door black. I love the look of the black hardware. That's kind of, that my wife and I, we love that type of design. But when we did the renovation, I painted my door black. I put new floors in. I painted the walls in the house. I made all these other capital investments in the home.
Right.
And so it wasn't like we were like, homeowners don't randomly make these choices. Homeowners that choose to invest in their homes are tending to invest in other things. So those kinds of studies are very, 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 should be very skeptical of those results. Unless we had a randomized experiment where we selected 500 houses, randomly painted the doors black on 250 of them, and then saw how they transact in the marketplace. Short of something like that, the statistics can tell you basically nothing. But with other types, so Brandon, to get back to your question, that's an example where we can look in the past to see how certain types of changes in the market influence property prices to get a sense of what might happen in the future. But when we're at the core of your question, I believe, is can we use the data to forecast where the market is heading? At a fundamental level, if we don't know what's going to happen in the future, the answer is no. How can we be sure? How can we be sure? At an even deeper level is every econometric statistical forecast. There's no way around it. As soon as you leverage data one way or the other, you are fitting a model to historical data and just extrapolating that trend. Some are more sophisticated than others, but there's not a lot of wiggle room with how you do this. And what that means is that at the core of every one of these forecasts is, for them to be right, you have to assume minimally that whatever is happening in terms of market fundamentals in the period that you have data, those cannot change in the period where you're forecasting the data. And I don't think I believe that. I can't imagine a world where market fundamentals are going to be the same 3 years from now as they are today. Yeah, I just don't buy that. And so for that reason, I think that we could take a very quantitative a theoretically driven critique of being cautious about these types of forecasts by simply saying that there is this implicit assumption that may or may not hold true. I do think that people who work in this space have a better feeling than anybody with data when it comes to where the market is going. There are things that, when I, from my shoes as a home buyer, you walk into homes and you just see certain things and you feel certain things and you hear neighbors talking about certain things. And there's all of that subtext when you're talking with an agent and you're looking at this prop. What is it? Is there scorpions in this house? Is there a crack in the foundation? Why? I don't see a lot of people listing houses nearby. What's going on? We ask. And all of that gives you a clue where a neighborhood is heading, at least perhaps over the next 6 months to a year. And so thinking carefully about, moving away from a world where we're just saying, let's extrapolate the past to predict the future. There's a place for it. And the way that I like to frame forecasting is forecasting can be useful if we interpret it for what it is and don't interpret it for what it isn't. A forecasted model is just saying, look, here is existing data. Let's fit the model and extrapolate. Well, that can be useful if we use it for the right questions. What that can tell us is if things stay on the trajectory they've been on, then home prices are going to be here if something doesn't change. Back in 2006, I was in a tract home, Tierra Linda, off of I-15, and we saw home prices going up $50,000 a year, $100,000 a year. And I was on one of these tract homes, and I remember sitting with my dad, and I took out a pencil and I went onto the shear panel plywood one of these homes, and I drew out like what I knew about home prices. And I said, Dad, I go, look, if things stay on the trajectory that they're at, these houses are going to be $700,000, $800,000, $900,000. That just can't happen.
No.
And we kind of looked at it and didn't think much of it. And then I was a student at the time as well. And I remember it didn't feel like that much long afterwards. My professor, Stephen Miller, a mathematical economist, walks into the class and says, do you guys know what happened today? I said, no. He's like, Lehman Brothers collapsed. And it was sort of, and then we know the history, the Great Financial Crisis. And so, that's really how I view market forecasting, at least when it comes to certain things like home prices. Other quantities are much more predictable. In terms of what we know about economic forecasting quantities, especially population counts, are much more robust and generally much more accurate than thinking about things like forecasting the housing market, because there's just so many. For example, the number of people might not change in a city, but prices could go up because of a wage effect. So you can get this situation, prices, and when you look at population growth trends, the data is always, frankly, kind of in your favor because they're much more stable than when you look at pricing outcomes. If you look at whether it's a mortgage interest rate or median home price, median rent, we see so much cyclicality, so much volatility, so much variability in contrast to more structural components of an economy like population trends. And so and that's another aha moment when it comes to statistical forecasting for the housing market, is even if the structural foundations of the market did not and would not change during the forecasting period and the extrapolation period, we still can't ignore that there's so much volatility in the market. And that volatility will persist in the forecasted period, which means that, again, when you increase what we call variance, which is just a bunch of noise in the data, things bumping and moving around, it does not bode well for forecast. And I know that
They just want to know, our listener just want to know, when would you buy your next house? Not just because they're
I'd be
I'm a
buying.
realtor and I can work with you, but
So I can't give financial advice, but I could tell you what I'd be doing.
okay.
I'd be buying a house right now. I would. I really would. I do not see any evidence. I don't see any evidence of price levels coming down, and I only see evidence of mortgage rates falling. Brandon, maybe you can find something pointing in a different direction, but I can't see any evidence suggesting that we're going to see a $50,000, $60,000, $70,000 decrease, holding property constant, right? Quality constant. And so I am of the opinion I'd like to buy now, because much of what's probably going to happen, especially the mortgage rates falling, I think demand's going to go up. I think price levels are going to continue to rise. I'd rather buy now, and I don't care about my mortgage rate. I can refinance that loan when the time is right and lock in and just come to terms with the price of housing we have now. And here's the cool thing about housing. This is if I went and bought a $500,000 house right now, or $1 million house right now, or a $2 million house right now. Okay, maybe it stings. Maybe it hurts. Maybe I'm reminiscing about the times of 2016 and 2013 and wishing, maybe I wish I would have got out of school a year earlier and bought a little earlier. We always have these stories.
Yep. And not had student loans.
Yep. But in 15 years, when that $1 million house turns into a $2 million house, you're looking back saying, man, I'm glad I spent that money. And that's the thing is we have to understand that when we're buying housing, we're buying an asset. And we have to, I think that the home buyer needs to understand both the dynamics of refinancing, that this is an option, and it's not costing hundreds of thousands of dollars to refinance a loan, right? Especially if rates drop. If I bought now, I might get lucky at the high sixes. Is that about right, Brandon? Something like this. And
Yeah.
right, and if they dropped 2.5 percentage points, right, I might be in the world of refinancing that property, and it's not going to cost me very much money to do that. And so I think that taking a very long term view on housing matters here, because we can't. The thing about time is time waits for no one. What's happened in the past is the past, and here we are. And what really matters is where we are going. And if the typical home buyer looked at where they stand now and where the market is going, as opposed to thinking about, oh, well, back in 2010 and I understand things have changed. I understand, and I do empathize at the core of my heart that housing is expensive. But if we're thinking about buying, not only can we not go into the past, the future is going to happen whether we want it to or not. Prices are going to go up. And I think that leads me to, again, a very long-winded answer to a frankly very simple question. What would you do? In my own opinion, I if I wanted to be in a home, and if I could afford it, I'd be buying a
That's the
house.
key.
That's right.
So Sean, going back to kind of predicting, I'm just curious, when you sat there with your dad and you diagrammed that out and you predicted what that price would be, have you priced it recently, that home?
You know what?
Because I'll bet
You
you're
know what?
not far off.
You know what? Oh my goodness. Let me
It may
pull
not
up.
have got there the way you thought it would, but I think it got pretty
Now
close.
you're asking me a data question, and you got to be careful, because I'll
You're
start
in.
looking at
He's
the.
ready to research.
So,
Brandon, while he researches, make sure you're researching a house with a black door for him,
Yeah.
or a house that he can easily paint a door black. And I think that a lot of these conversations also, like everything that we talk about in trying to help get tenants to be these first time home buyers, right? I think that we talk about rents and we talk about, the business that we're in is turning, we everything that we come from, like our position is like a fair and balanced approach, right? So what's a fair and balanced approach to landlords and tenants, and what's a fair and balanced approach to get this tenant to be a first time home buyer, to actually like have that opportunity for generational wealth? What does that look like? And so we like fiercely, I'd say, like advocate for those opportunities, because we want to turn those tenants into homeowners. Because how good does it feel? And obviously we know there's going to be, some time that things shift down, but like if you could hold on to that asset, what does that look like for them, for their family, for their opportunity as they move through life?
so important. And one thing that happened this year is the gap in wealth between homeowners and renters has now reached a U.S. historical high. It is at the very highest level we've ever seen it. And when we're talking about public policy and housing, there is much emphasis on what we call area median income, AMI. And many policies in terms of what level of subsidization a tenant could get in an affordable housing unit, for example, will depend in large part on where they fall with respect to area median income. Now, here's the thing. When we're thinking about helping renters get into homes, part of the equation is what's happening with asset values, home prices. Other part of the equation is what's happening with debt, interest rates, and also what's happening with the average income of the typical home buyer. And this is why almost it doesn't matter what economic study we read, we're thinking about what's happening to wages, what's happening to income. But with housing, there are two markets. We have the market for rent and the market for sale. And when we're thinking about first-time home buyers, we're typically thinking about a family or a household or an individual exiting the market for rent and entering the market for owner-occupied housing. My colleague Nick Irwin and I thought, well, why don't we look at the data and study something very simple? What does the median income for current owners look like relative to the median income for renters? The median income right now in Southern Nevada, on average, is about $80,000. If you split the market survey respondents into renters and owners, there's a $40,000 per year gap between the average renter and the average homeowner. And so while we're thinking about what's going on with median income, when we're thinking about housing policy, we need to start acknowledging that these, again, going back to this idea of we can't use every market trend to tell a story of each individual homeowner or individual. We need to start understanding that the economic characteristics of renters do differ from those of existing homeowners, and that can certainly change and influence how we think about public policy that addresses housing.
Yeah. So fascinating. In closing, do you have any memorable experience or a success story or anything in your career that you would love to share with us?
I would. So when I was in the construction field, I was working on a property over off of El Campo Grande Avenue near Robert Combs Pig Farm. And I went out there and I didn't know at the time what was going on. And I realized, man, it stinks out here. And so I started doing research on the pig farm. Coincidentally, the same time period, I was in a law and economics class at UNLV. And we had to do a study of sorts on something that fit into some legal doctrine. And the doctrine that I picked was the coming to the nuisance doctrine, which basically said something along the lines that, look, if you were aware of the nuisance and came to the nuisance, then let the buyer beware. You're sort of assuming the purchase, right? And so I thought, well, homeowners might be complaining, and I'm not going to say it smelled good. It didn't, but Robert Combs was there, 50 years before these houses were built, and also 13 miles from any recent nearby development at the time. I would think that home buyers probably received an indirect discount in the form of the purchase price of their house. So I proposed the study, and I went onto the Clark County Assessor's webpage. I picked one property at a time. I put it into an Excel spreadsheet. I computed the distance to the pig farm. I assembled this data, and I did my very first study of housing market, just trying to estimate that proximity effect of being next to that farm. So I was a student, didn't think much of it. I go on to get a PhD in real estate econ from University of Pittsburgh. And that first semester I was at Pitt, I remember people asking and talking, well, what are you interested in? What do you research? And what do you study? And do you have any papers you've worked on? And, at Pitt, phenomenal department, phenomenal faculty, and really phenomenal colleagues that in my cohort. And man, they were studying some amazing stuff. Macroeconomic determinants of this, all these technical things that half of the things I didn't understand at the time, frankly. But what did you study, McCoy? Oh, I studied the pig farm and housing, and it was it was just it was a bit different. So flash forward another year, and I remember my advisor, great mentor and phenomenal researcher himself, came into my office and said, look, remember that study you did with the pig farm and housing prices? I said, yeah. He's like, you think you could do that again, but instead of housing prices and the pig farm, what if it was a wildfire and a home? I said, yeah, it's basically the same thing. I said, well, by the way, we have a National Science Foundation grant, and we'd like you to join the grant and help us do the study. And I joined the grant with my advisor. It was and we began to explore the interplay between climate risk and the market for housing. And at the time, it's about 2013. I remember, I remember one of my colleagues is poking fun. He's like, "That's kind of a niche area." I said, it might be. I go, but the data seems to suggest that in the next 10 years, these wildfires are going to change. And so I think it's important to study it now. And it changed the entire trajectory of my entire career. We would not be talking right now. I would not have published where I published and presented where I presented, or, I went on to work with people from around the entire world talking about housing forecasts and how. And the thing about wildfire and housing is, unlike other climate risks, if I put more housing on the coast, that's not going to cause a hurricane to say, "Oh, I see more units. Now I want to go hit the market." Housing is a bit different. When you bring more people to forested landscapes, not only can the mere presence, also true of Northern Nevada, the mere presence of housing change how fire spreads once fires do ignite, but you can think about potential changes in human caused ignition and all these things. So fire and housing have very complex interrelationships. And much of what we're thinking about forecasting fire was somewhat agnostic to how the housing market might respond to changes in global climate risk. And really what we did is really tried to bring housing economics and climate modeling together to have a better understanding of what's going on with housing, and this values at risk of loss due to things like you're seeing now out on the East Coast.
That is so impressive. You are so impressive. And that actually, we need another podcast episode because, as you know, wildfires are a massive issue in our state and across the country. And I think we're having a lot of conversations around insurance and wildfire risk right this minute. And
That's
so,
right.
uh,
In 2000, 2 years ago, it's still on my LinkedIn profile. My
Hmm.
colleague and I pulled data on housing growth and what we call the wildland urban interface.
Yeah.
We call it the WUI. This is areas where housing units intermingle or interdigitate with sprawling spider-like configurations with vegetated landscapes. So think about how basically housing in the forest. And that's where we think about all these big fires hitting. So what I knew from our 2013 research was, in 2013, more than 1 out of every 3 residential homes across the US was in the wildland urban interface. About 38.5% of housing units. That actually grew to 43% over the next decade. But we thought, which states are seeing the highest rates of growth of housing units in the wildland urban interface? So we took the data and we mapped it at the state level. And we ranked every state based on how much new housing growth is happening in the WUI. Number 1 state in the US, Nevada.
Wow. Did you know that, Brandon?
No, but I would have guessed California, but I'd say that's probably number 2 or close to it.
Yeah.
Wow.
Yeah.
Okay, we're actually way over time, but you have done like just such an incredible job. I'm so happy that our members, our listeners are going to get a chance to listen to you. And if they want to hear more about your work or getting involved in LEAD, how do they find you?
Great question. So if you go to our one of the best ways to connect, and I can send you the link after the talk, leadcenter.unlv.edu is our website. And if you go to research and reports, you'll have access to much of the studies that we've done recently about the housing market. And you can also sign up for our newsletter. And one thing that is important to us is we don't inundate readers with content. We'll write a study and send it. We don't send intermediate content. We just really try to get the right information to people so they can stay up to date with what we're doing.
Well, thank you so much, Doctor. You've been absolutely incredible today. Brandon, is there anything else? Any final questions?
Well, I just wondered if his brain ever shuts off. But seriously, I just want to thank you for your time and thank you for all the partnerships we've had over the past years with the LEAD Institute and the Realtors. Thanks so much.
I want to thank you guys too. The level of intellectual engagement and of with the real estate community in this town is remarkable. It really is. And the truth is, a lot of what we study, not mostly all of it, is based on ideas and challenges and concerns we're hearing from the public, from agents, from homeowners. And so without that dialogue, we can't do our job. So having that willingness and wantingness to engage, to think about these issues is really what we use to propel this work forward.
Mhm. Thank you. And that's so great to know, because I think that like oftentimes our members don't know, like they actually want to know how the sausage is made. And I think that that's something that we've kind of, said, let us just do our work behind the scenes and then we'll report to you. But I think that now more than ever, both the consumers and the members like actually want to know what conversations are being had, what work's being done, what research is being done. So they're actually like really fascinated in all this. And so we again appreciate the work that you do. And I could listen to you talk all day. I mean, I just wish that I had notes that I was taking as you were talking, but lucky to have this relationship with you. You're incredible, and to grow what our relationship looks like across the state. So thank you again for coming on.
You are very welcome. Pleasure was all mine.
Great day.